Right, let's jump straight in. Today, we're going through a comprehensive explainer of 10 absolutely crucial money-making option strategies. We're going to take a journey, right from your basic beginner setups all the way up to those advanced Wall Street-level maneuvers. Whether you're looking to generate some steady income, maybe protect a portfolio you've already built, or literally place calculated bets on market volatility, options are the ultimate toolbox for defining your risk. So grab your notebook and let's unpack exactly how these work and, more importantly, when to deploy them to protect and grow your capital. We're breaking this journey down into 4 distinct levels today. Level 1 covers beginner stock strategies. Level 2 moves into directional spread plays. Level 3 is for the volatility hunters. And finally, Level 4 tackles advanced market grids. All right, starting at Level 1, beginner stock strategies. These are foundational setups where you already own the underlying stock. They're basically the perfect entry point if you're newer to options, simply because they build right on top of traditional stock ownership. Think of strategy number 1, the covered call, almost like a protective, income-generating umbrella for your stock. This is a core income strategy. Here's how it works. You own 100 shares of a stock, and you sell or write a call option against it. Your main goal? Generating steady, reliable premium income in a market that's just kind of going sideways or maybe slightly up. The buyer pays you a premium for the right to buy your shares at a specific strike price. Now, the trade-off here is pretty straightforward. You're tapping your upside gains. If that stock suddenly rockets to the moon, you still have to sell your shares at that agreed-upon strike price. But hey, if the stock stays flat, you keep the stock and you keep the premium. It's a genuinely brilliant way to squeeze extra yield out of assets you're already holding. Moving to strategy 2, the protective put. This is literally an insurance policy for your portfolio. Let's say you own a stock, but you're a bit worried about a short-term drop. You just buy a put option. That gives you the right to sell your shares at a predetermined price, completely capping your downside risk. So say you own shares at $100 and buy a $95 put for $3. The absolute maximum you can lose is $8 a share, even if the company goes completely bankrupt tomorrow. The trade-off, of course, is that paying that premium eats into your overall profit. But honestly, during times of heavy market uncertainty, that peace of mind, it's incredibly valuable. Okay, let's level up to level 2, directional spread plays. This is where things get interesting, introducing stock acquisition and targeted directional bets, but without needing to actually own the shares first. Strategy 3 is the cash-secured put. This is where you sell a put option. But, and this is key, you keep enough cash in your account to actually buy the shares if you're forced to. It's an ideal setup if you have a neutral or bullish outlook. Your goal is pretty simple. Either earn the premium if the stock stays above your strike price, or acquire that stock at a discount if it drops. The catch is you might actually be assigned the shares. But look, if it's a company you already want to own at that lower price anyway, this is a phenomenal way to literally get paid while waiting for your perfect entry point. Before we hit the next 2 strategies, let's talk about the mechanics of vertical spreads. By buying and selling options at different strike prices, you create either a net debit or a net credit. See, instead of just buying a naked option, which, let's face it, can get wildly expensive, you buy one option and simultaneously sell another of the exact same type and expiration to offset the cost. You're significantly lowering your upfront financial risk. The trade-off? You are capping your maximum possible reward. So let's compare 2 classic vertical spreads. Strategy 4 is the bull call spread. You buy a call and you sell a higher strike call. Your goal is profiting from a moderate upside, so it's perfect for controlled, bullish moves. On the flip side, strategy 5 is the bear put spread. Here, you buy a put and sell a lower strike put, aiming to profit from a moderate downside during controlled bearish moves. The big takeaway for both: efficiency. By selling that second leg, you drastically reduce your cost of entry compared to just buying a single option. You just have to accept that strictly limited profit ceiling. And look, if the broader market suddenly takes a massive hit, a well-placed bearish spread acts just like a financial bandage, actively minimizing your portfolio's exposure. It lets you capitalize on downward movement, but without exposing yourself to the massive, theoretically unlimited risks of naked short selling. All right, level 3, the volatility hunters. Congratulations on making it this far. We're now entering the advanced realm of non-directional volatility plays. With these, you don't really care if the stock goes up or down. You just need it to move dramatically. Let's do a quick face-off between 2 classic volatility hunters with admittedly kinda aggressive names, the straddle versus the strangle. Strategy 6 is the straddle. You buy a call and a put at the exact same strike price.
The goal is profiting from a massive price explosion in either direction. It's perfect for things like earnings reports or major economic events. But since both options are at the money, straddles are notoriously expensive to set up. Strategy 7, the strangle, fixes that high premium problem. You buy a call and a put at different out-of-the-money strike prices. It's way cheaper to enter, but the trade-off is it requires a significantly wider price swing to actually hit profitability.
Prepare yourselves, because we have officially reached the boss level of our explainer. Level 4, Advanced Market Grids. These feature advanced neutral and time decay strategies that require multiple legs. This is the intricate stuff the pros use. Strategy 8 is the famously named Iron Condor. You're basically combining a bear call spread and a bull put spread into one giant trade. The goal here is the exact opposite of the straddle. You actually want to profit from low volatility. If you think a stock is just going to trade in a boring, sideways, range-bound market, you cast this wide net. If the stock just chills between your inner strike prices through expiration, you keep the premium. You're accepting a capped profit in exchange for strictly defined risk, because those purchased wing options protect you from a catastrophic blowout.
Next up is Strategy 9, the butterfly spread, named because its payoff graph literally looks like a butterfly with a central body and 2 tapering wings. It involves combining multiple calls or puts across 3 different strike prices. This is a pinpoint prediction tool. Your goal is to profit if the underlying price lands right near that central target on expiration day. Because you're buying wings to protect a central short position, it heavily reduces your trade cost, but, and it's a big but, it significantly narrows your winning window.
Our final strategy, number 10, is the calendar spread. This setup involves buying and selling options with different expiration dates, but the exact same strike price. Your goal here is profiting purely from time decay differences. You're basically selling a near-term option that's going to lose its time value super quickly, while holding a longer-term option that retains its value much better. This is best for neutral market outlooks where you're expecting sideways movement in the short term. You're just patiently letting time do the heavy lifting for your profits. Wow, we've covered a massive amount of ground today, from the simple income generation of a covered call all the way to the pinpoint accuracy of a butterfly spread. So, the really crucial question is, which of these 10 strategies actually aligns with your specific risk appetite, your market outlook, and your portfolio goals? You don't need to master all 10 to be successful, but you absolutely do need to master the ones that fit your style and protect your capital. Remember, trading options shouldn't be about blind speculation or treating the stock market like a casino. It's about systematically defining your risk and tailoring your exposure to the exact market conditions you're anticipating. So go review your charts, assess your capital, and ask yourself, are you going to keep gambling, or are you ready to define your risk and conquer the next level of your trader's journey? Thanks for joining me on this explainer, and I'll catch you in the next one.
If you enjoyed this video, make sure to subscribe to the channel, like this video, and turn on the notification bell so you never miss the latest updates on AI stocks, market analysis, and new investment insights. Thanks for watching and supporting the channel.